In this video, we will be discussing the modern portfolio theory with regard to financial institutions' loan portfolio, and we will also talk about regulatory models. To the extent that a financial institution manager holds widely traded loans and bonds as assets, or alternatively can calculate loan or bond returns, portfolio diversification models can be used to measure and control the financial institution's aggregate risk exposure. Suppose the manager can estimate the expected return of each of loan or bond in the financial institution's portfolio. And after calculating the individual security return series, financial institution manager can compute the expected return on the portfolio. So you can see that this is the expected return on the portfolio of asset. And let's say that this portfolio consists of the bonds, those are publicly traded. So you have the price data, you calculate return, and each of these return is multiplied by its corresponding weight of that bond or of that asset in the portfolio, and we sum them up so we get the expected return on the loan portfolio. Now, the fundamental lesson of modern portfolio theory is that by taking advantage of its size, and financial institution can diversify considerable amount of credit risk as long as the returns on different assets are imperfectly correlated with respect to their default risk adjusted return. So you can see that return on the portfolio is the weighted average return of the individual assets. However, the riskiness of the portfolio or the variance of the portfolio will not be weighted average risk of the individual asset, it will be less than that. So by definition, the variance of the portfolio will be the variance of individual asset and the square of that asset's weight, and then sum of the weight of asset 1, weight of asset 2. For example, if it's 2 asset portfolio, then correlation between asset 1 and 2, and then standard deviation of asset 1 and standard deviation of asset 2. Now, this variance of this portfolio is less than the weighted average variance of the individual asset, and that's the benefit of combining individual assets in a portfolio. So as the point I said, that you understand that if this term is not here, then there is no benefit of diversification. In that case, the variance of the portfolio will be a weighted average variance of individual assets. However, as this correlation comes and the assets are less than perfectly positively correlated, for example, if this correlation's value is anything less than 1, then the variance will be less than what the weighted average variance is. Consider that the variance of the portfolio, if many loans have negative covariances or negative correlation that I am talking about, the correlation of the returns are negative. When one borrower's loan, one of the borrowers, one loan do badly and another's do well, then combining loans to both the borrowers may reduce the financial institution's overall credit risk exposure. That is, if there is negative correlation across borrowers' default probabilities, then a portfolio of loan may be less risky than an individual loan, all else being equal. Thus, the sum of the individual credit risk of loans viewed independently overestimates the risk of the whole portfolio, because correlation, since there is a correlation, and there will be some offsetting features. Now, let's say that if there are two asset case and the correlation is negative, in that case, the second term in this equation will also be negative. That means this term will become negative and will offset the first term. So it will offset the first term as a result. So this part is the variance of the individual assets. So this part will offset this part. As a result, the variance will decline. So which will all now by appropriately exploiting the correlation relationship among asset and financial institution can significantly reduce risk in the asset portfolio and improve the portfolio's risk return trade-off. That is what we find in industries such as fund management or superannuation funds, where portfolios will be diversified across many asset types. financial institution can reduce this by taking advantage of large numbers in their investment decisions. So they can combine a huge number of assets in one portfolio, and when they would be negatively correlated or less than perfectly positively correlated, so the risk will be offset. As a result, the overall riskiness will be lower compared to the weighted average riskiness of the individual assets. That means what is more important here from an overall financial institution's loan portfolio point of view, rather than looking at the individual loans risk, we should look at the contribution of individual loans on the riskiness of the overall portfolio, because that is more relevant. Now, to see more generally the advantage of diversification that we have been talking about, look at this figure. In this figure, this point A is an undiversified portfolio with heavy investment concentration in just a few loans or bonds. By fully exploiting diversification potential with bonds or loans whose returns are negatively correlated or that have a low positive correlation with those in the existing portfolio, the financial institution manager can lower the credit risk on the portfolio from, you can see that when you are having an undiversified portfolio, your risk is here. Now, combining securities in a portfolio and having the diversification benefit, the risk can be reduced from this the sigma PA to sigma PB. So you can see that you generate the same rate of return, but at a lower level of risk. So the portfolio B is the efficient portfolio. I'm talking about this one. This is more efficient portfolio associated with portfolio return level. By varying the required portfolio return level, RP up and down, I mean, as you move along this line, the portfolio, each of these portfolio mix is efficient in the sense that it offers the lowest risk level to the finance manager at each possible level of portfolio return. However, as you can see, that all possible efficient portfolios be generated, portfolio B produces, this is the point I'm talking about, portfolio B produces the lowest possible risk level for the financial institution manager, because this point is the furthest in the left. So this is a portfolio that generates the lowest risk. So it maximizes the gains from diversifying across all available loans and bonds so that the manager cannot reduce the risk of the portfolio below the sigma PB level. So for this reason, this portfolio will be considered as minimum risk portfolio. Now, as we have discussed about this portfolio model can be applied for the loans or the bonds. Those are publicly traded and the price or the return data is publicly available. However, below, we look at one approach originally developed by KMB Corporation, which is currently known as Moody's Analytics, called Portfolio Manager. We see that Moody's Analytics Portfolio Manager model differs from the portfolio theory that we just discussed, is that it does not require loan returns to be normally distributed. Further, Moody's Analytics has developed a proprietary model to estimate the value of infrequently traded loans. So this is not publicly traded, or they are infrequently traded. Thus, the Moody's Analytics model is unique in the way it estimates the return and risk and correlation between loans in a financial institution loan portfolio. Once these variables are estimated in the Moody's Analytics Portfolio Manager model, they are then incorporated into standard modern portfolio theory equation that we've seen in the last slide to get an estimate of the risk and return of the financial institution's portfolio. Okay, so we calculate these inputs: the expected return on the loan to borrower, the risk of a loan to borrower correlation, and then put them in the model that we have seen in the last video. I'm sorry, the last slide. So detail of this calculation is provided in your textbook, so you can have a look for a detailed understanding of these terms. Now, we are talking about the regulatory models. The regulators of financial institutions have also been investigating ways to measure concentration risk. Historically, concentration limits have been criticized for appearing somewhat arbitrary in the way the concentration limits are selected. However, with the introduction of the Basel II set of regulations for Australian depository institutions, we see greater reliance on more quantitative model, such as the Moody's analytics that we just discussed in the last slide, also credit metrics, credit risk, so on. Now, just a brief discussion on the managing credit risk using derivatives. So in a previous chapter, we discussed about the derivative instruments, and we discussed that they are useful in managing interest rate risk. So here we demonstrate that by diversifying their loan portfolios across different borrower sectors and regions, financial institutions can diversify away much of the borrower's specific and unsystematic risk. Of course, the ability of the financial institutions manager to diversify sufficiently depends in part on the size of the loan portfolio under management. Thus, the potential ability to diversify away borrower-specific risk increases with the size of the financial institutions. In recent years, new types of derivative instruments have been developed, for example, forwards, options, swaps, to better allow financial institutions to hedge their credit risk. Credit derivatives can be used to hedge the credit risk on individual loans or bonds, or on portfolio of loans and bonds. The credit derivative market, while it's still young, has already gained a reputation as an early warning signal for spotting corporate debt problems. The emergence of these new derivatives is important as more financial institutions fail due to credit risk exposures than to either interest rate or foreign exchange risk exposure. Credit derivatives such as credit default swaps allow financial institutions to separate the credit risk exposure from the lending process itself. That is, financial institutions can assess the creditworthiness of loan applicant, originate loans, fund loans, even monitor and service loans without retaining exposure to loss from credit events such as default or missed payments. This decoupling of the risk from the lending activity allows the market to efficiently transfer risk across counterparties. However, it is also loosens the incentives to carefully perform each of the steps of the lending process and can result in poor loan underwriting, shoddy documentation and due diligence, failure to monitor borrower activity, and lastly, fraudulent activity on the part of both lenders and borrowers. Now, we see an example where, let's say, that a triple B bond at the time of origination may have 2% spread over US Treasury of the same maturity. So a credit forward is entered. It means that this CSF is the agreed forward credit spread at the time of contract return, and CST is the actual credit spread at the maturity of the forward contract. MD is the modified duration on the benchmark bond, and A is the principal amount of the forward agreement. Now what's happening is, look that you are an investor, you are investing in a triple B rated bond, for example, and let's say that the yield you are expecting is 5%, and the interest rate on a treasury is 3%, for example. Now, so 5% is the triple B bond, and 3% on the treasury, and the spread is 2%. Okay. Now, so what is this? This is the agreed forward credit spread at the time of contract is written. Okay. Now, what can happen is, over time, the credit risk might go up. So as the credit risk might go up, the yield should go up. Let's say previously it was 5%, now it goes up 6%, 7%, 8% because of the increased credit risk. So this is the actual credit risk spread at the maturity of the forward. Now you can see if this actual credit spread is greater than the agreed spread, it means that you are taking, as an investor, you are taking more credit risk. As a result, you will receive a compensation. Okay, you will receive a compensation if you are the credit spread seller, I mean the bank, so you will receive a compensation from the counterparty that actually originated this forward contract. So this is how the credit derivatives can be used in managing credit risk. Now, managing credit risk using loan sales and securitization. You know, in previous chapter, we discussed about loan sales and securitization. Now we see that these loan sales and securitizations can be used to manage credit risk as well. So first of all, if we talk about loan sales, while loan sales have been in existence for a long time, there is increasing recognition that they are a valuable additional tool in a financial institution's portfolio of credit risk management technique. Indeed, it has been found that new loan announcements are associated with a positive share price announcement effect for the financial institution, even when the loan is traded on the secondary market. Okay, so loan sales usually involve the splitting of large loans and can involve the sale of portfolio of smaller loans, although the latter is not common in Australia. So sale of loans or part of loans with recourse means that the buyer takes the credit risk. So in this way, as you are originating a loan, but part of the loan is sold to others, you are actually reducing the credit risk in the portfolio. Okay. And also, if you think about asset securitization, that involves pooling of loan in the financial institution portfolio and selling pool to a firm which can issue securities based on the loan pool's cash flow. As the loan pool is sold, the credit is transferred to the buyer rather than holding the credit risk by yourself. So both these loan sales and asset securitization allow financial institutions to separate the credit risk exposure from the lending process itself. That is, financial institution can assess the creditworthiness of the loan applicants, originate loans, fund loan, and even monitor and service loan without retaining the exposure to loss from credit events such as default or missed payments. This decoupling of the risk from the lending activity allows the market to efficiently transfer risk across counterparties. Both loan sales and securitization can also assist with industry and geographical concentration risk. For example, a financial institution may have a loan portfolio that is heavily concentrated in mortgages to households and small businesses in a regional center. Given this degree of concentration, the financial institution is exposed to downturn in the regional economy. For example, and even occurred in Australia in 2011 when most of the state of Queensland, including the capital city, was flooded, bringing economic activity in the state to a standstill. The cash flow of many households and businesses were impacted by the floods. The financial institution can diversify their portfolio geographically by selling these loans originated in the regional center and buying loans from the financial institution in other regions. So in this case, you actually reduce the loan concentration. Through loan sales and securitization, financial institution can better manage their customer relationship. For example, an excellent customer with a financial institution may require a loan, while financial institution may not want to take an additional risk. It can satisfy the customer by making the loan and then selling it through participation as a whole or through a securitization, a special purpose vehicle. In this way, financial institution can unbundle balance sheet risk management from customer relationship management. So you are not denying your customer a loan, and also you are not taking risk because you are lending to the customer and then selling it to others. So maintaining the customer relationship. Now, the Bank of International Settlement, BIS, Risk-based capital adequacy rule often provide financial institutions manager with strong incentives to sell or syndicate large business loan to downsize their balance sheets and to boost bank capitals. And last of all, moral hazard issues. While loan sales and securitization offer credit risk management options to any financial institution, they can also create a moral hazard problem. For example, as the loans are not being kept on the financial institution's balance sheet, as the credit risk is being transferred to buyer of the loan, there could be a loosening of incentives to carefully perform each of the steps of the lending process. This may lead to poor loan underwriting, and failure to monitor borrower activity, even fraudulent activity on the part of both lenders and borrowers. So in summary, in this chapter, we learned about the simple models of loan concentration, diversification of loan portfolio, and regulatory models. Thank you very much.